Hello, my awesome accounting students. Welcome back for chapter 24.
Last chapter, which is chapter 24, I do consider this one of the more important chapters for two reasons. If you're a business major, you're all going to take an upper level finance class at the university where they are going to dive deeper into what we're going to be talking about today. Even more importantly than that, I think the concepts that we're going to learn, especially in day 2 of chapter 24, are concepts that you can apply to retirement planning and developing that retirement portfolio, which is something that I strongly believe that we all need. You've probably heard me say, if you've had me in a semester or two, that Social Security is a system that is broken right now. And even if we live, or you guys live long enough to see the results of it, if that's your sole source of retirement, you will be a poor older person. And I'm watching that in action with my own family members right now. So a lot of what we're going to learn, especially in day 2 of chapter 24, will have absolute relevance to helping you make wise decisions about future investments. Pretty tight packed agenda. Chapter 24 is very important. So we're going to talk about what exactly is capital investment analysis. And basically what we're talking here is we're looking at the ability to evaluate long-term investments, and there's usually competing investments to decide which one is the best for your circumstances. So the reason that this chapter is important is capital investments usually involve very large dollars, sometimes in the millions if we're talking about a company. It involves very long time periods. And because of the long time periods, there's lots of uncertainty built into it. And also because of the large dollars, sometimes loans have to be taken out and they're not easily reversible, right? It's not like I spend a couple $1,000s buying a computer, which is also considered a capital investment, and I make a poor decision. The worst thing that happens is I'm out a couple $1,000s and I got to replace the computers. But the thing that I'm talking about usually involve things like corporate expansions, buying a piece of very large equipment that you hope to benefit your business for a long period of time, possibly expanding internationally. I've done an investment analysis for a corporation that was considering expanding to Mexico. That would be an example of a capital investment analysis. So because they're large dollars and long time periods, which brings with it lots of uncertainty, they're not easily reversible. So it's very important that we take a hard look at the facts up front so we can make a wise decision. And then we'll talk about through the PowerPoint and also through the handout an overview of how it works. And basically what we're after is we need to plan out the life cycle of this investment, which means how much is it going to cost up front? How much is it going to cost to maintain over the life? What type of cash flows or net income is it going to bring back to us? When you get to your upper level finance classes, you'll talk about income tax complications as well. In this class, we're just doing the bare basics. In fact, we're going to give you 4 methods that can be used to analyze capital investments. And your author is going to break it down into present value methods and non-present value methods. Today, we're going to focus on the non-present value methods. And let me plug in my computer here, charger, just to make sure there. Sorry. Today, we're going to focus on the non-present value methods. And what that means is, and we'll talk more about this next time, but present value means a dollar received today has more value than that same dollar to be received a year from now or 2 years from now, because money has a time value to it. And so the first 2 methods that he's going to introduce to you in the book are non-present value methods, which means these methods do not consider the time value of money. Because of that, they're easier. And I would say that they tend to be used for screening purposes, which means that if all of a sudden, and this happens at Cerritos sometimes, it also happens out there in public companies. If all of a sudden the company has money for investing purposes and they're looking for projects. Cerritos might say, hey guys, we have $2 million worth of grant money to fund any improvement programs for education. Send us your proposal. And they get like 50 or 60 different proposals from across the company or from across the campus. They may use these first two to screen proposals. And then those proposals that meet the first set of criteria will then be subject to more advanced methods of capital investment methods, which do involve the present value. And the reason I'm bringing this up is because you're going to see in the writing project that you guys will deal with next week, that there's going to be some screening criteria. They have to meet some basic cash payback and some basic accounting rates of returns before they're subject to further advanced methods of analysis. So that's what we're talking about today. There are a total of 4. You'll see them listed for you on the handout I provided. We're going to be looking at 2 closely today, maybe the start of a third. The 2 that we're going to be looking at today are non-present value related methods. The first is the cash payback, and I want to emphasize the word cash. This is cash based, and it answers the question of how quickly can I get my cash back? And as in all cash payback analyses, the quicker you get your cash back, the better off you're going to be. So the shorter the cash payback, the better off the investment is. And then we'll take a look at another method, which, unlike the cash payback, looks at GAAP net income. So they call it the accounting rate of return. It is the only one out of the 4 methods that we're going to be looking at in this chapter that focuses on GAAP net income instead of cash. And because we're responsible many times to our investors who are very cognizant of the bottom line of what GAAP net income is, some believe that that has a big advantage to it over the other 3 methods that we're looking at. When we look at these 2 methods today, and all the methods actually, we'll go through the advantages and disadvantages of each. And I wanted to let you know that in the handout that I gave you in the module, I believe the very last page has a pretty good summary of the advantages and disadvantages. And then we'll spend definitely next class, maybe some of today, but probably next class, talking about the present value methods, those methods that do consider the time value of money, which means that that dollar today is preferable than that dollar to be received a year or 2 years or 3 years out. We'll talk about how do we turn it into today's dollars, and is the money that we'll be receiving in the future worth what we're paying for it today? And if you think about it, that's kind of what retirement planning is all about. That's why I said that this chapter has great relevance to those of us that may be considering good investments for retirement, because retirement planning is all about, is the benefit I'm going to be receiving in the future in my retirement worth the money that I'm going to put into it in today's dollars? And that's what this net present value method will try and answer. And then the last method, which we'll definitely get to next time, is called the internal rate of return. I think the book severely underemphasizes the importance of the internal rate of return. I believe that out of these 4 methods, it is the most telling method, because unlike these others, it's going to give us an exact internal rate of return. It used to be, even 30 years ago, 20 years ago, when I was back in college, in my normal college classes, I still take college classes to this day, but back in the day when I was an accounting student learning how to do this, the internal rate of return required us to use calculus techniques, interpolation techniques to get to the actual number. So it wasn't highly used because it was fairly difficult to do. But now with Excel being on desktops, on everybody's desktops, it's very easy to set up an internal rate of return in Excel. And I'm going to show you how to do that. That's where we're headed today. That's kind of a preview of the chapter. Again, the importance of the chapter, again, is we're talking large dollars, long time periods, higher risks of uncertainty. So because of that, this is a chapter that your author put in at the very tail end knowing that we're just scratching the surface here. There's a whole lot more into these 4 methods than what we're going to have time to scratch the surface of. And that's why all business majors will be required to take that upper level of finance classes where you'll really dive into these 4 methods with some of the more complicating factors that come in. So I would encourage you guys, as usual, to use these agendas as checkoff lists for the tests, because I think it serves as a good summary of what we'll be looking at. And if I don't have any questions, we'll go look at the PowerPoints. If you do have questions, I certainly want to get those answered. Does anybody have any questions? Okay. PowerPoints then for this chapter. I'm going to, again, not go through all of these. You guys do have access to all of the PowerPoints in the modules link. So capital budgeting or capital investment is the process of analyzing, you'll notice the word, let me get my pencil here, long-term investments and deciding which assets to acquire or sometimes to sell. The capital budgeting process can be done any number of ways. Usually it's department or managers submit proposals. You have a budget committee that will evaluate those proposals. And usually there's capital rationing in place, which means this: we only have so much money to go around. So we have to find a way to judge or look at all the different proposals that come in, right? And the analogy, the really oversimplified analogy I use is, I'd love to drive a new car every week, but there's not enough money to be able to do that. So I need to ration my money and maybe have, I'm not a car person, but if I was, maybe have 4 or 5 different cars because that's all my budget would allow. By the way, I have 1 car. I just use that as an example. Okay, so capital budgeting require very careful analysis. We take an in-depth look because they are riskier. The reason that they're riskier is they involve long periods of time. And I mean, look at what we find ourselves in a position of right now, just economically. There is great economic uncertainty. There is inflationary pressures right now that some would say might be spiraling out of control. This pandemic that we're in has created a whole new set of economic circumstances. We're not so sure what's going to happen 2 years down the road, 4 years down the road, 5 years down the road. And so we need to be very careful that we take a specific look at some of the risk factors. So here's the reason why capital budgeting is important. And you saw me list these earlier as we were going through the agenda. There is uncertainty. We're not 100% certain, for example, when we expand to Mexico. We think plans will go according to our plan, but the outcome is uncertain because of that longer term nature. There usually are very large amounts of money involved. Because of that, there are also sometimes loans or financial commitments tied to these. The decisions are often difficult or impossible to reverse. Again, when you expand to Mexico, especially if you're building a plant, this company happened to be leasing a plant, but it's not easy to get out of a lease. So these decisions can many times be difficult, sometimes impossible to reverse. And again, we're talking about long time periods. So that's what the capital budgeting process involves. And then what we're going to be doing as we go through these exercises is looking at the life cycle, what I call the life cycle of a capital expenditure. Again, think about the cars you have. There's a cost of acquiring the car. We call that the acquisition cost or the initial cash outflows. Then there's the cost of maintaining or running whatever type of investment you're looking at purchasing. And then at the end of the life, again, thinking back to cars, because many of us have purchased cars in the past, there's what do you do when you're done with it? There's disposal questions. What can we get? What kind of salvage value can we expect at the end of the life? So again, we're going to be looking at 4 methods. 2 are non-time value methods and 2 are time value methods. Okay, the first 2, the non-present value, we're not looking at the time value of money, is called the cash payback. And you'll notice the author calls it payback. I keep referring to it on purpose as the cash payback because that will help remind you that the payback looks at cash. So what we're going to be calculating is what your author refers to as the payback period. You're going to see me also call it, I'm going to add cash payback. That will help you on the test remember what we're looking at, because out of these four methods, it will either be looking at cash flow or it will be looking at net income. There is a difference between the two. This method specifically focuses on cash, and so I want that in your notes. This is cash-based. And the payback period of an investment is the amount of time it takes to recover the cost. So what you're after on this cash payback, you're asking yourself this question: how long is it going to take me to recover my investment? So the answer is going to be in a time frame, right? It's not going to be a percentage like most of the others. It's going to be in a time frame. The shorter the time frame, the better the investment is. So if you have equal annual net cash flows, which by the way, rarely happens in practice, you can use this shortcut formula. So only if you have equal annual cash flows, you can use this shortcut method. And I would write this formula down in your notes. It's the cost of the investment on top divided by the equal annual net cash flows on the bottom. Okay, which makes sense. If we have an investment that, let's say, costs us $10,000 to do, and we're bringing in an annual cash flow of $2,000 a year, we would take $10,000 divided by $2,000, and the payback period on that would be 5. Okay, in real life, most investments don't bring in these equal annual cash flows. So we got to find another way, not just this cookie cutter formula, to be able to analyze that. And again, this last blue box, the shorter payback periods tend to be the better ones. Whoops, let me go back. This method has a severe disadvantage to it that I definitely want to cover, especially when we get into the Excel worksheets. But let's look at the example that they gave. So again, here's their formula. The cost goes on the top, and the annual net cash flow, that's important, goes on the bottom. So we would be looking at cash flows. Now they came up with 4,100, and they'll give you the rationale in the PowerPoint if you want to go back and calculate that. But all I'm showing you is that when you have nice, easy numbers, this one comes out to about 3.9 years. Let me give you the major disadvantage right now. This looks at how quickly you get the cash back. So with this example they gave us of 3.9 years, if you have a cash flow coming in let's say year 5 or 6, it completely ignores it because it only counts the cash until you get your cash back. So if you have a large boom, I'll call it, in years 5 and 6, and the investment's really starting to bring back money, the cash payback period doesn't consider anything past the cutoff date. I consider that a big disadvantage. Other people would say that it's easy, it focuses on cash, and so many times it can be used for screening purposes. Most of the investments that we take a look at are not going to have equal annual cash flows. And I know this is hard to see on the little PowerPoint. So instead of using that formula, what we're going to do is schedule the cash out so that these numbers are given to us. And you'll notice up here that the author starts off with a negative cash flow. That's the cash outlay to purchase this asset. So a lot of students have trouble understanding how a cash flow can be negative. That's the initial acquisition of this asset. And then look what they do. They just keep adding the cash back. Over here, you'll see cumulative net cash flows. They just keep adding until they hit 0. So in this slide, you'll see that someplace between year 4 and 5, they hit the break-even point. They get back to 0. That would be the cash payback. So you'll notice, and we'll do our own example that'll make a whole lot more sense in this PowerPoint. You'll notice that after year 4, it looks like They still had $1,000 to go. So they take that $1,000 over the next cash flow coming in. So there's that $1,000 left in year 4. Over the year 5 cash flow, it's going to take 0.2 years. 0.2 years. That's how they come up with the 4.2. We're going to definitely cover that in our first couple of exercises. So if that seems a little confusing, I feel 100% confident that once we work on the Excel problem, it won't be that bad at all. So let me go on to the next slide. Well, let me stop here. Any questions on those first? It looks like 9 slides. Okay.
I'm sorry,
go ahead.
Is there a definition of long-term, or does it depend on the situation? What is long-term in this situation?
Long-term can vary by company. Most companies, I would say, look at anything past 3 to 4 years as long-term. So even when we're talking about living, even I'm trying to make it real simple where you guys can relate to something too. When we talk about living conditions, right? In the short term, it might be okay to rent for 1, 2, 3 years, but in the longer term, you want to look to hopefully be able to purchase that house, which most people think is also an investment to live in. So that's a really good question. There's short term, which is usually 1 to 2 years. There's midterm for most companies, anywhere from 3 to 4 to 5 years. And anything beyond 5 is usually considered long-term.
Okay.
Yeah, great question. Okay, so again, I'm going to refer you to the handout. Make sure you guys don't discount the handout on this chapter. The last page does a really good job of showing you the advantages and disadvantages to each one. So the strength, let me make this a little bit back so we can see the slide. The strength is, most people look at this as a strength. It is considered with cash, and cash is king for many companies. They want the cash back as soon as they can get it. It is probably the easiest out of all the methods to use, so it has that going for it. The author identifies 3 weaknesses. One is definitely does not reflect differences in timing of the cash flows. In other words, they don't look at money coming in sooner in the year versus later in the year. They just look at it as coming in year 1 or year 2. The major one that I see as the biggest deficit here is that it totally ignores cash flows after that cutoff period. In other words, if the method finds that you get your cash back in year 3, let's say, it totally ignores there might be $1 million coming back out there in years 4 or 5. So that's what I consider to be the biggest deficit. And like these first 2 methods that we're talking about, the time value of money is not considered. We'll learn more about the time value of money next time. But when we're looking out longer term, and Neff asked a great question, what is considered longer term? When we're looking out 4, 5, 6, 7 years down the road, we should be considering the time value of money, because that can deeply discount what the value of a dollar is worth in the future. And we'll be using tables to do that. I'm going to dive in deeper than what the book does next time, because for retirement purposes, I think it's really important that we have a good understanding of the time value of money. So we're going to use the tables, but I'm going to talk a little bit about the math behind the tables, because I think it's important for us to have a good understanding of that. So that's going to be the first method that we tackle today. While we're on these PowerPoints, let's take a look at the second method. It's called the accounting rate of return. It is the only method. In fact, in my head, I remember this as the GAAP accounting rate of return, because it is the only method that focuses on GAAP net income. All the other 3 methods are going to focus on cash, and net income is important to shareholders. Companies are expected to meet earnings targets. There's not cash targets that the shareholders are looking at. They're earnings targets. And so many people would say that this has the advantage of looking at the bottom line, our net income, and that's what our shareholders are interested in. That's what our CEOs and CFOs are probably getting profit sharing bonuses based on, an annual bonus basis. And so the plus to this one is it's the only method that's taking a look at GAAP net income. And here's the formula. You will hear me again refer to this as GAAP. Let me get my second A in there. GAAP average annual net income after tax. Like we know that if we were to look at a corporate income statement, it would be after taxes. So that's why I use the word GAAP. When I remember GAAP net income, I think, okay, bottom line of the income statement divided by the average investment. There's lots of ways to calculate an average, right? And we've talked about this before. If I wanted to know what's the average age in the class, I could list all 35 people that we have, I think right now. I would list all their ages in the most accurate way. I would divide by 35. I'd have an accurate age. I could also do a quick and dirty method. You could take a look at the oldest person, probably me, and the youngest person, and we could find the midpoint of that. So there's lots of ways to calculate the average. What your book is going to use to calculate that average, it's going to take the cost plus the salvage value, because the salvage value comes back to you at the end, and it's going to divide by 2. It's also what I consider a quick and dirty way of finding the average investment. So that's going to be the formula that your author uses consistently. Just know that there's very accurate averages and then there's loosey-goosey type averages. Because it's a survey class, your author is using one of the easiest ways to calculate the average. When you take that upper level finance class, hang on to these notes. They'll come in handy, but your instructor will dive deeper into what we're going to be looking at. And so let me just bring up one more slide on how to calculate it. But again, I think this will make a whole lot more sense when we do it ourselves. And there was that $16,000 investment that they were looking at. So if we use the beginning book value, that's the cost. There is no salvage, that would be 0. And we divide by 2, that would give us an average investment here of $8,000. So what goes on the top is the average annual GAAP net income. And what goes on the bottom is the cost. This one will result in a percentage. Like most percentage-based methods, the higher the rate of return, the better the investment is said to be. So that's what we're going to be focusing on today in our Excel exercises here. Again, always in the back of your mind as you're doing your homework, I want you to be thinking, what are the pluses of this method? What are the minuses of this method? The pluses of this method, I mentioned to you, it is the only method out of the 4 that focuses on GAAP net income. And because GAAP net income is really important to shareholders, as well as the people who run the company, they probably have compensation tied to net income. That would be a good reason for using the accounting rate of return. But there's also some weaknesses. And one of the weaknesses, as we said with cash payback, is that it is not a time value based method. So it ignores the time value of money. Although I think this is a strength, your author says that the focus on net income could be considered a weakness as opposed to focusing on cash. And if the income varies each year, the project may appear desirable in some years and not in others. That's where that upper level finance class is going to help you make some judgment decisions on that.
Okay, let's get our hands dirty and take the topics we just talked about and get some practice in. So the first exercise gives information for 2 alternative projects involving machinery investments. The first one requires an investment of $140,000. The second one requires a lesser investment of $90,000. Letter A says compute the annual net cash flow. Okay, that word's going to become important to us. Net cash flow. And then compute the payback period for each of the 2 investments. Okay, letter A talks about the cash flow, the annual, in fact, cash flow. So let me change the color of this. Let me put in letter A here. And letter A is the annual net cash. I'm going to write that in big letters, flow. Okay, be very careful as you take a look at how the author presents the information. Sometimes he'll give you cash and sometimes he'll give you net income, and they are two very different numbers. So looking at the box here, it looks like he is giving us net income and we need cash. So you could look at this one of two ways. You could take that net income and convert it back to cash by backing out any non-cash items, specifically depreciation. As we know, depreciation is a non-cash cost. Depreciation is a systematic allocation of the cost of an asset over its life. So one easy way to do that would be to take a look at this net income of $8,000, then add back the depreciation. So I'll show you that way, net income, and we're going to add back the depreciation because it is a non-cash item. And let me give myself a little bit more room here. The annual net cash flow for that first investment was $8,000. For the second investment, it was $7,000. And we're going to add back the non-cash item. Let me move this down. Sorry about that. The non-cash item was that depreciation line item. I'm going to add it back on the first investment, add it back on the second investment, and we just converted our net income back to the net cash flow, which is needed for the cash payback. So let me go ahead and put a line in here. We will compute that net cash flow. The other thing you could have done alternatively was you could have just done a little miniature statement here on a cash basis, and you could have excluded the depreciation line item, and you would wind up with the same answer. So letter A has been answered. Letter B says, what is the cash payback period for each investment? Make sure I put these investments up here. And I'll get rid of those decimal places so it doesn't confuse anybody. Okay, if we remember correctly, the net cash payback period, when the flows are equal and annual, we can use a shortcut. And the shortcut says take the initial cash investment and divide by the annual net cash flow. So there's our formula. As you guys are doing your homework, I strongly encourage you to write down the formula each and every time. That way you won't forget it, and by the time the test comes around, you will have it ingrained in your memory. All right, the first one took a cash investment of $140,000. The second one took a much smaller cash investment. The annual net cash flow we just computed up above here. Whoops. And when I get my calculator out, in this case, Excel is going to be my calculator, and I do that series of divisions, I'm going to get an answer. And remember what your answer is showing. This is a cash payback. So that is a time period. In this case, it's going to be the number of years. So 5 years on the first one, 3.6 years on the second one. If we could only pick one investment, in other words, we had capital rationing in place, and we would go with the second investment that brings the cash back in a shorter time period. So I'm going to put up a reminder here. The shorter the cash payback term, the better the investment. So if we could only pick one, we would pick that project 2 because it brings our cash back to us in a much more expeditious manner. On to the next one. This exercise will take a look at a payback period with unequal cash flows. So because the cash flows are uneven, we can't use that shortcut formula. So what I've done is I've scheduled out the years from 0 to 5, And what we're going to do is input the items systematically, keep track of the cumulative cash flow, and the payback period will be where that cumulative cash flow reaches 0. So in year 0, which means right now, this asset costs us $180,000. And as you can see, the cash flows given in the chart are uneven. So I'm just going to go ahead and list them out. 60,000 in year 1, 40,000 in year 2, 70,000 in year 3, 125,000 in year 4, and then it drops down to 35,000. The cumulative cash flow is just going to keep track of the cash as it increases. So in year 0, we're down in the hole 180,000 because we spent that much. In future years, all you're going to do is take the previous cash flow and add that to the year 1 and continuously update the last column. And I'm not at 0 yet, so I'll keep going. When I add 40,000 back to that, now I'm at minus 80. I'm not at 0, so I keep going. Minus 80 plus 70 will get me to a minus 10. And I'm still not at 0, so I keep going. Minus 10 plus 125,000. You can see now I'm above 0. So the payback happens someplace between year 3 and year 4. Now, if you were to write in an answer like that the cash payback period is somewhere between year 3 and year 4, that would not be specific enough. So right now, I know my cash payback is 3+ years, and that somewhere in the 4th year, we get our cash back. How far along? We take that $10,000 that we had left to get to 0 from right here, and we divide the cash flows in that year. And what that tells us, once I put a couple decimal places on it, is that it's 8/100 into the year. So a more accurate answer would be 3.08 years. And again, let me put a couple decimals so that will stand out to you. And if for some reason on an exam or on a quiz or something, they ask you, well, how many months is that? How many months is that 0.08? We would take that 0.08, and since there's 12 months in a year, we would multiply that by 12. And again, let me put a decimal place on that. It would be almost 1 month. So our answer is 3.08 years. And if you had a multiple choice question or something that asked you in years and months, how long is that? This would be 3 years and 1 month. So cash payback is a quick and easy way to compute how quickly we can get our cash back. The disadvantage is, although we have this large cash coming in year 4, it completely ignores the cash after the payback period, and that is the biggest disadvantage. On to the next one. Let's take a look at the accounting rate of return. One of the best things going for this method is it's the only method that utilizes GAAP net income. So one thing I would strongly recommend on every homework problem, write down the formula on a piece of paper before you work the problem out. That will help remind you of whether you need cash or GAAP net income on each of the 4 methods that we're learning. And it would also help you to cement the formulas into your memory. So on the accounting rate of return, we have average annual GAAP net income on the top and the average investment on the bottom. The denominator is calculated as cost plus salvage value, that whole sum divided by 2. In this case, we have project number 1 and project number 2. And we'll start with the numerator, the average annual income is $15,000 on the first one and $12,000 on the second one. Let me go ahead and put these projects in, project 1 and project 2. So in our numerator, we have the average annual GAAP net income. And then the denominator, make sure you use parentheses when you do the calculations, is the cost of the investment plus the salvage value, which is 0 in the case of the first project, that whole sum divided by 2. If you don't put those parentheses in or you don't do the calculation correctly, you'll wind up with a different answer. So on the bottom, my cost is $90,000. My salvage value is $10,000. I would take that entire sum and divide by 2. And when I pop that into my calculator, we will get 25% on the first one. And on the second one, we will get 24%. So if we were only able to select one project, we would select project 1 because it has the higher rate of return. This exercise is going to pull the first 2 methods together. It says B2B company is considering the purchase of equipment that would allow the company to add a new product to its line. Perfect example of a capital investing decision. The equipment costs $360,000, always a relevant cost, so I'd circle that. Has a 12-year life and no salvage value. The expected annual income, be careful, the author goes back and forth. Sometimes he gives you cash, sometimes he gives you net income. You need to be able to convert one to the other. So the expected annual income for each year from this equipment follows. You'll see that in the box below. And the author asks you to compute the annual net cash flow, which is used for 3 out of the 4 methods that we're learning, the payback period, and the accounting rate of return for this equipment. So letter A, compute the net cash flow. They gave us net income. We need to convert it back to cash. That means we need to get rid of any non-cash items. And this $30,000 that you see in that income statement is an example of a non-cash item. So my starting point is net income, and I will add back depreciation, and that will get me to my net cash flow. So my starting point is the $36,750 that the author gives me. The depreciation is $30,000. And by the way, if you're wondering how they came up with that $30,000, that's the cost divided by the salvage value. And when we add those two up, once I put an equal sign in here, we will have the net cash flow. Once again, that net cash flow is used for 3 out of the 4 methods. Let me highlight that. Okay, letter A done. Letter B, compute the cash payback method. Since these are equal annual cash flows, okay, how do I know that? Because your author says each year. We can use the shortcut method. We can take the cost of the investment on the top, and we would divide by the annual net cash flow. So the cost of that investment was $360,000. The cash flow we just computed up there in yellow. Let me pull that down. And when I divide the cost by those cash flows, I come up with a cash payback period equal to 5.39 years. Always make sure you include that denomination, whether it's percentage or dollars, or in this case, years. 5.39 years it's going to take to get our money back. And finally, they want you, let me fix my spelling error here. They want you to compute the GAAP. I always remember GAAP accounting rate of return. So on that one, we're going to take the average GAAP net income on the top, and we'll divide by the average investment. And again, get in the habit of writing down the formula. That's the cost plus the salvage value. The whole thing is divided by 2. The GAAP net income is $36,750. The average investment is the $360,000 plus the 0 salvage value divided by 2. And when I pop that into my calculator, the average accounting rate of return would be, let me put a percent format and at least 1 decimal, 20.42%. Take a look at those, make sure you understand what feeds each formula, and continue practicing until you feel like you've mastered the topics. On to the next one. Our wrap-up problem today will have us compute the payback period, and then will also introduce us to one of the time value methods that we'll talk about more in the next class, called the net present value method. We'll do the first 2 requirements today, and we'll leave that 3rd requirement for our next class period, where we'll come back and talk about present value methods, including the net present value method that this question asks you to compute. So this problem says Cortino Company is planning to add a new product to its line. To manufacture the product, the company needs to buy a new machine at $300,000. That's something you should highlight. Cost is always relevant to the decisions to be made. It has an expected 4-year life and a $20,000 salvage value. Additional annual information, annual is keyword, it means that we're getting that amount each year, for this new product line is as follows. They give you the information in the box, and they ask you to do 3 things. Requirement number 1 says determine income, that would be net income, as well as net cash flow for each year of the machine's life. And then number 2 says compute the machine's payback period. Okay, that's important. That means we'll need a cash flow number to do the cash payback. And this assumes that the cash flows occur evenly throughout the year. I think it's easiest to calculate the net income first and then compute that into net cash flow. So step number 1, determine net income and net cash flow. So I'll start off by creating an income statement, and you can put the requirement in there. I don't want to get distracted. We have sales, and then we're taking a look at all the expenses that it takes to create this product that this new machine will produce. That would mean direct materials, direct labor, and all the factory overhead exclusive of depreciation. We know that also because they give you depreciation on the next line item. We'll start off by computing net income first, and then they give us the selling, general, and administrative. So I'm just copying this off of the chart given to you. The sales are $1,150,000. Direct materials, I think I'll create some space here. The direct materials are $930,000. The depreciation is $70,000. You should be able to compute that on your own by looking at the information. And the SG&A is $115,000. Let me go ahead and add those up. I'll call this total expenses, and I'll sum those up. Whoops, there, equals sum. And my net income will be the difference between the revenues and the expenses. Let me go ahead and get a box ready to accept that number, and I'll let Excel compute the difference. Remember that this is annual, so you may want to remind yourself that this is coming in each year. Okay, that's step 1, half of step 1. Now let's do the cash flow. So what we just did is we computed net income, and now I'm going to convert that back into cash. We learned earlier that the way to convert the net income into cash is to get rid of any accruals and deferrals. In this case, the main deferral is depreciation. So we'll start off with the net income that we just computed up above, and we'll add back depreciation. And that depreciation was given to us as $70,000. That means that our net cash flow, and again, I'll mention that that is annually, so we don't forget, is the sum of those two. In this case, sorry, I think I multiplied those instead of adding them. Give me one more second. They're okay. Fingers are getting tired at the end of the day. There we go. Net cash flow is $105,000. Okay, so we've fulfilled the requirements of number one. Number two, we need to know which of those two numbers to use to compute the, I call it cash payback period. And the reason I revised that name a little bit is so I can remember which is which, and what the cash payback period uses is the cash number. Because these are equal annual cash flows, I can use the shortcut formula, which says take the cost of the investment and divide by the equal annual cash flows. Okay, the cost of my investment was $300,000. The equal annual cash flows would be that green number that you see that we just computed. Let me make that green so you can see where it came from. And when I take those two and I divide them, we will get how long it takes to get our cash back. I would suggest putting at least one decimal place on it, 2.86 years. And then this last requirement is going to ask us to compute the net present value for the machine using a discount rate, or another rate for that is a hurdle rate or an internal capital rate of 7%. And that will lead us right into our next lecture. So read up on the net present value method, and when we come back next time, we'll continue this problem and we'll finish it off by completing requirement 3. This is Professor Johnson signing out.